On the same day, the FTSE 100 posted its biggest single-day gain in a month. The two companies most responsible for that index's strength over the past 6 weeks were being hammered. BP fell 7.5%. SHEL dropped 6.5%. While mining stocks and airline groups surged double digits, the oil majors gave back a month of war premium gains in a single session. The trigger was a 2-week ceasefire between the United States and Iran, announced late Tuesday night. Brent crude fell 14% to $93 a barrel. For most of the market, that was unambiguous relief. Lower energy input costs mean wider margins, eased inflation pressure, and the prospect of rate hikes being dialed back. British Airways owner IAG gained 10%. Rolls-Royce climbed 11%. Miners Antofagasta and Anglo surged more than 10%. The FTSE surge Thursday came too late for the UK housing market. March data from Halifax showed average house prices fell 0.5% in the month to £299,677. Annual growth slowed to 0.8% from 1.2% in February. That reversal traces directly to what happened in the mortgage market when the war began. Before the conflict started in late February, the average 2-year fixed mortgage rate was 4.83%. By early April, it had risen to 5.90%, the highest since July 2024. Hundreds of the cheapest deals were withdrawn in a single week, the largest daily withdrawal of mortgage products since Liz Truss's mini-budget in 2022. The mechanism is straightforward. Oil above 100 pushed inflation expectations higher. Higher inflation expectations pushed gilt yields up. Higher gilts pushed mortgage swap rates with them. Wednesday's ceasefire has not reversed that chain. Mortgage lenders reprice based on sustained swap rate moves, not single-day oil drops. Adam French at MoneyFacts said the ceasefire is more likely to slow or pause mortgage rate increases than trigger any sharp falls. Halifax's Amanda Bryden was direct. How long the housing market weakness lasts will depend on how long the inflationary pressures prove to be, not on whether the ceasefire holds for 48 hours. The structural damage is already embedded. Grocery inflation is forecast to hit 9 to 10% by mid-year, driven by fertilizer costs. A third of global fertilizer supply transits the Strait of Hormuz, and diesel costs for agricultural logistics. Even if Hormuz fully reopens today, the supply chain recovery for refinery capacity and shipping logistics is measured in weeks to months, not days. The UK energy price cap, currently set at £1,641 until June 30, was on course to spike sharply at its July reset. Wednesday's oil drop has created some room for that reset to come in lower, but Capital Economics is careful to note this depends entirely on whether the ceasefire holds and what form the Strait reopening takes. The central tension the ceasefire did not resolve is the gap between what markets priced in Wednesday and what the real economy will experience over the next 3 months. Traders scaled back Bank of England rate hike bets sharply, from 2 hikes priced in before the ceasefire to just 1, with only an outside chance of a second. Sterling climbed 1% to 1.342, its highest since March 23rd. Bond yields slid. The relief was real, and the repricing was rational given the oil move. But the Fed's Vice Chair Philip Jefferson articulated the asymmetry clearly. Core inflation had already stalled above target before the war added energy costs on top. Even if crude stays at $93, the lagged effect of 6 weeks of $100 plus oil is still working through supply chains. Jefferson said he expects the Fed's preferred inflation gauge to show 2.8% in February, before the war. The UK's own February CPI of 3% was similarly pre-war. March and April readings will be the first to capture the full energy shock. The weight of evidence points toward a slow and incomplete recovery rather than a quick reversal. The ceasefire buys time, but oil analysts at Wood Mackenzie and the US EIA both said it will take weeks, not days, for normal supply flows to resume, and months for refinery capacity in the Gulf to return. That path holds if the 2-week truce converts into something durable and Iran fully reopens the strait without conditions. If the ceasefire fractures, if Iran's Supreme Leader Khamenei's statement that the war isn't over yet proves to be more than rhetoric, or if Israel's continued strikes in Lebanon escalate the regional picture, crude rebounds toward $110 and the mortgage market faces a second wave of product withdrawals. The Bank of England would then be forced to choose between hiking into a stalling housing market or letting inflation run further above target. The specific benchmarks to watch. First, whether gilt yields hold below 4.85% over the next 5 trading days as swap rates stabilize. Second, whether the July energy price cap reset estimate from Ofgem comes in below the pre-ceasefire trajectory. Those 2 numbers will tell the UK housing market and mortgage holders whether Wednesday's relief was a turning point or a pause.